How does spring return after a crash? Old data reveals the real timeline of stock market recovery. Imagine this. The market opens in the morning, the screen is flooded with red, the value of the portfolio is melting away, and every second person is asking the same thing. What should we do now? Some people are selling in panic. Some shut their mobile phones the moment they see the loss. And then there are others who quietly start carrying this fear inside them, that maybe this time the market may never come back the way it used to. And this is where the real story begins. Because a falling market does not just bring money down, it brings trust down too. And the biggest question is always this. Does spring really return after a crash? Or is the story of recovery limited only to books and the words of old investors? The nervousness being seen in the Indian stock market these days is not small. According to Reuters reports from March 2026, both the Nifty 50 and the Sensex have fallen more than 10% from their all-time highs and entered the technical correction zone. At one stage, the Nifty 50 showed a decline of up to 8% in the first half of March, while financial stocks and banks saw even sharper weakness than that. The Iran war, the spike in crude oil, pressure on the rupee, and selling by foreign investors weakened sentiment. In other words, today's fear is not imaginary. The market is genuinely under pressure. But this is exactly where history quietly tells a different story. The thing that feels like a disaster to us today has many times in market history turned out to be just a temporary phase. This is the very point veteran investor 𝐟𝐨𝐥𝐿𝐴 recently raised through a shared data table. According to Mint's report, the historical data compiled by his EQ research team showed that from the USSR invasion of Afghanistan to the Gulf War, the 9/11 attacks, the Lehman Brothers collapse, the GFC peak fear phase, and the COVID crash, the Sensex often showed meaningful recovery in the medium term after major crises. According to the same data set, after such major crisis events, the Sensex delivered an average return of 10% in 3 months, 17% in 6 months, and 26% in 9 months. The most important thing to understand here is why the market falls in the first place. Whenever there is a major geopolitical shock, terror attack, banking collapse, pandemic, or war, the market reacts not to facts, but to uncertainty. What do investors fear the most? The unknown. They do not know how expensive oil will become, how much earnings will fall, how slow the economy will get, what impact there will be on interest rates, where the currency will go, and whether this crisis will spread and turn into a much bigger financial damage. That is why the initial reaction often overshoots. In other words, sometimes the market prices in imagined damage even before the real damage actually arrives. If we look at the 2008 Lehman Brothers crisis, it was not just the bankruptcy of one bank. It was the collapse of global financial trust. According to the data cited in Mint's March 2026 report, the Sensex fell nearly 29% after that event. At that time, the world felt as if the very foundation of the banking system had been shaken. But the same data set also shows that after the Lehman collapse, the Sensex recovered 58% in 6 months and 69% in 9 months. In other words, the phase in which people were running away from the market later turned out, in hindsight, to be one of the best buying windows. Then came the COVID crash of 2020. It was a time when the world literally shut down. Flights stopped, factories closed, offices became empty, and people did not even know when the economy would reopen. According to the historical table given in Mint's article, the Sensex fell 37% during the COVID crash. At that time, the fear was not just about valuation, it was about survival. But as liquidity support arrived, panic selling slowed down, and the markets began to discount future reopening. The recovery became sharp. According to the same data, after COVID, the Sensex rose 34% in 3 months, 50% in 6 months, and as much as 81% in 9 months. This shows that when the market falls, it falls fast. But when it returns, many times it returns even faster than that. The same pattern was seen after 9/11 as well. That attack did not just shake America, it shook the entire world. The uncertainty, fear, and security concerns were so deep that global risk appetite was badly affected. According to the table quoted in Mint, the Sensex fell 17% after the September 11th attacks. At that time, it was not easy for any investor to remain calm. But this is the nature of the market. It falls on present fear and rises on the hope of future normalcy. Not every crisis ends the same way, but the market's built-in mechanism eventually begins to search for normalization. Now the question arises, how does recovery actually come? Its mathematics is not as simple as it looks, but its basic logic is clear. When fear is at its peak, even strong companies start getting sold along with weak companies. Valuations get compressed. Good businesses, those with strong balance sheets, better cash flow visibility, and intact long-term demand structure, also start becoming available at a discount. The moment uncertainty reduces even slightly, smart money returns first to these very businesses. This buying gradually builds the structure of recovery out of the debris of panic. The second big reason in this process is liquidity and expectations. The stock market prices future expectations more than present earnings. When a shock arrives, the market quickly prices in the worst-case scenario. But in the real economy, the deterioration is often less than that. Or governments, central banks, institutions, and businesses manage to control the damage. The moment investors begin to feel that the world is not going to end, the market starts to rebound. That is why many times the market starts going up even before the bad news is over. Because the market discounts not the present headline, but the direction of the coming 6 to 12 months. If we take history a little further back, the pattern becomes even clearer. The Gulf War ultimatum, the Gorbachev coup, the Asian crisis, the Japanese tsunami, the Libya bombings, the Iraq invasion. Mint's report included many such episodes. The impact of every event was not the same. In some events, the initial decline was bigger. In some, it was smaller. And in some rare cases, the immediate reaction was mixed too. But the broad takeaway was that the short-term reaction remained volatile, while in the medium term, stability and rebound often returned. Mint's report clearly says that averages are not guarantees, but recurring patterns cannot be ignored either. Now look at today's situation through that same lens. According to Reuters' March 2026 coverage, India's benchmarks are in correction. Foreign portfolio investors have done heavy selling, oil prices have spiked, pressure on the rupee has increased, and governance-related news, like the sudden resignation of the HDFC Bank chairman, has added to the fear as well. If an investor is reading only these headlines, it may feel as if this decline is going to last a very long time. But market history teaches us that not every correction should be seen as a collapse. This does not mean at all that every fall will turn into a jackpot in the next 6 months. It is also true that some recoveries remain weak. Some crises keep causing pain for a long time, and some sectors change permanently. In some episodes like the Asian financial crisis and the Japanese tsunami, the medium-term recovery was not as spectacular as it was after Lehman or COVID. So historical averages should not be seen as a fixed promise. But ignoring them would also be wrong, because they reveal a deep pattern of investor psychology. Usually, the panic phase is the most brutal, and that same phase later becomes the most misunderstood buying window. That is why, during a crash, the biggest question should not be how much more can the market fall, but how should I behave? Most retail investors do not lose in the market because of lack of money, but because of behavioral mistakes. They buy expensive stocks in the euphoric phase, then sell in fear during the crash, and remain outside until the recovery has already started. Market history teaches again and again that losses do not happen only because of the fall, they happen because of wrong timing. The investor who sells quality assets in panic often ends up missing the strongest part of the recovery. The real test of long-term investing does not happen in a bull market, it happens in a bear phase. When everything is green, the portfolio is growing, TV anchors are optimistic, and multi-bagger stories are running on social media, staying invested is not a big skill. The skill is when the screen in front of you is red, the portfolio is down, and the fear inside you is telling you to hit the exit button. That is the time when an investor should look at their thesis, asset allocation, emergency fund, and holding quality, not the headline. If you have bought weak, speculative, manipulated, or fundamentally poor stocks, then the pain in a decline will increase. But if the portfolio has solid companies, diversified funds, or sensible allocation, then correction can also become an opportunity. The core message of 𝐼𝐨𝐻𝐿𝐼's shared analysis was also exactly this: the war will end. This line sounds simple, but in the context of investing, it is very deep. Not every crisis is permanent. Not every headline becomes a lifetime event. What hurts the market the most is uncertainty, not certainty, the moment some visibility returns. Whether through a ceasefire, policy support, earnings clarity, oil stabilization, or valuation comfort, capital gradually starts moving back toward risk assets. And when capital returns, the rebound often shocks those people who had already exited during the fear phase. Even in the context of the Indian market today, some balancing factors are visible. Reuters also wrote in its March 2026 reports that after sharp falls, value buying emerged, recovery came in some sessions, and domestic investors partially supported the market through buying. This means that even in the middle of panic, bargain hunters quietly become active. The market bottom does not announce itself by ringing a bell. It is usually formed in the middle of confusion, disbelief, and selective buying. That is why the investor who waits for perfect clarity often misses the perfect price. But there is one important caution here. Buy every dip sounds attractive, but in reality, it is not that easy. Buying should not mean blindly averaging. Quality, sector risk, balance sheet strength, valuation, debt profile, earnings visibility, and time horizon matter a lot. The market may recover, but not every stock recovers. At the index level, history may look encouraging, but the fate of individual companies can be very different. So looking for opportunity in a crash is wise, but jumping in without analysis is not. If this whole story is turned into one investor lesson, then it would be this: do not look at a market crash only through the lens of fear. History says that after sharp declines, the probability structure of recovery has often remained positive. The data of average 3-month, 6-month, and 9-month rebounds points in that direction. But the even bigger lesson is patience. The market does not reward you when you are the most excited. The market often rewards you when you have not abandoned discipline. That is the psychology of compounding. Returns are created not just by company growth, but also by investor patience. So if you are thinking of selling after seeing today's decline, then remember history once. During Lehman, the fear was that global finance would collapse. During COVID,
The fear was that economic life would stop. During 9/11s, the fear was that the world had entered a new age of terror. Every time the market broke. But every time eventually, the market found its way back to normalcy. Recovery did not come at the same speed every time, but it came. So the question is not whether the fall is scary or not. The question is whether you will think like the investor who sees every crash as the end, or like the investor who understands that the most beautiful springs of the market often return only after the deepest
This
fear.
video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.